and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Even though AMD will be a viable number 2 to NVIDIA in the AI chip market, and even though the stock trades at a discount to NVIDIA, I just go with the pure play. I just buy more NVIDIA on this news and continue to avoid AMD, which has been a good trade for me.
Obviously, we got the stronger ADP rating this morning, but that really has not been a great indicator of what we should expect to see in those monthly reports from the BLS. We're still expecting only 90K jobs added in October in that data on Friday. There will be issues of strikes and hurricanes in that data. This GDP report today, of course, very positive, but a bit backward looking at this point. Most of this Q3 data we already knew.
Look, I think we're going above 100,000 on Bitcoin. I think the regulatory clarity you're talking about actually matters more for the so-called altcoins, for Ethereum on down. Those are more exposed to regulatory risk. So I would expect an altcoin rally, even more so than a Bitcoin rally in the event of a Trump win. But regardless, I think both are moving higher.
We got 1 hour to go until the market close. We're taking a look at the major averages here. Another mixed picture today. A lot of things influencing us, but let's run through the numbers real quick here. We got the Dow up by about 31 points or so, about a tenth of 1%. The S&P, though, is down by about the same amount, and the Nasdaq's down about 0.2 of 1%. We had some economic data today, right? We had our vision of third quarter GDP. We had ADP numbers, sort of presaging Friday's jobs report. We had PCE as part of GDP. So pending home sales, by the way, rising the most going back to 2020. So
there was a lot of data coming out. I mean, U.S. economy, bottom line, expanding robustly again. I mean, really saw another solid increase in consumer spending, Julie. Now, of course, what investors want to know is whether that's sustainable.
Right. And
they're having plenty of economists because they look at the saving rate or the growth in wages and they're kind of skeptical. We'll see. Yeah,
we will see. And, there wasn't any kind of conclusion from all that data that really changed the the diagnosis, if you will, of what the Fed's going to do, at least not as read through the prism of the 10-year yields, 4.26%. So kind of, not much movement there. Of course, the other big story that we continue to watch is what's going on with earnings and individual movers here. So for that, we look at our trending ticker list. We're going to get to Supermicro Computer later. Reddit shares at a record after their numbers. Eli Lilly shares tumbling after their numbers. And we're also seeing it play out on the index level. As we mentioned, the Nasdaq doing worse today, even though you have Alphabet, which is up by 4% and, trading going back towards record levels.
Yeah, Meta and Microsoft after the bell. Google, look at that nice 4% pop. Mark Mahaney telling his clients, nothing but ROAI. Financial analyst humor.
And then quick look at the Dow as well, because there too, of course, we had a lot of earnings reports. Most notably, just want to flag Caterpillar down 1.5% after its results. Visa up 3% after its results. So again, this sort of push and pull from all these individual stories.
All right, let's get some more take on what's coming up after the bell, because we've got big tech earnings and they are heating up. Microsoft and Meta on deck today to report their quarterly results. Here with what investors should keep a watch for is Yahoo Finance's very own Dan Howley. And Dan, let's start with Microsoft.
Yeah, Josh, I mean, look, this is probably one of the bigger names in AI outside of obviously the biggest, NVIDIA. They don't report till the end of the month, which is just mind-blowing to me. But Microsoft has been the beneficiary of its partnership with OpenAI. That gave it first mover advantage when it came to all of this kind of explosion in software. Now we're seeing the likes of Google catch up, Meta catch up, which I'll get to in a second, as well as Amazon. But for the numbers, let's just go over real quick what we're expecting from Microsoft. Their analysts are calling for $3.10 of revenue, per share on revenue of $64.5 billion. That would be up from $2.99 last year and $56.5 $1.5 billion in revenue. Commercial cloud, now this is the thing that everybody's going to be keeping their eyes on. Analysts are expecting revenue of $38.1 billion. That would be up from $31.8 billion in Q1 in 2023. Then obviously the intelligent cloud segment, that includes things like the Azure platform. That's expected to top out at $26.4 billion versus $24.2 billion last year. Those are the ones that I think most people are going to be keeping their eyes on. But there's some other statistics and segments that are worth watching. The productivity and business segment, that's going to get some changes this time around in terms of reporting. So the Azure business is going to be more, I guess, indicative of the consumption rates that Microsoft charges and sees as far as revenue goes. And then the more personal computing business, that's going to give us some info on what's going on with Windows as well as the Xbox hardware segment. So those will be interesting to watch. But like I said, the main thing that everybody's going to be looking at is that commercial cloud revenue number and then Azure as it kind of goes.
And how much they're spending, also, how much they continue to spend. That is also going to be a theme, of course, for Meta. Meta shares, by the way, are at a record today, and they're up about 70% year to date. So with the exception of NVIDIA, Meta's been, the Mag 7 that has been ripping this year.
Yeah, and part of that is of course, AI. And it really, I think, comes down to the fact that, you look at Microsoft, you look at Google, you look at Amazon, they have plans for AI, they're rolling out products with AI, but when it comes to Meta, it's just going right now. The products that they have are hitting, advertisers are using them, and then they're also going into the consumer products, which by virtue of them being an internal product, helps Meta as well. So I think that's what people are really interested in. They're seeing these benefits immediately with Meta offering advertising services that are boosted by AI. And so for that, we're expecting EPS of $5.25, up from $4.50 last year, and revenue of $40.2 billion. The advertising revenue specifically, we're looking at $39.7 billion versus $33.6 billion last year. And then let's just give a little shout out to the Reality Labs segment. That's going to bring in $312 million versus $210 million last year. So,
but how much is it going to lose?
A ton of money.
Yes, we'll be looking at that number, of course. But since the rest of the business is doing well, there's been less agita, perhaps.
AI's got people
losses.
all kumbaya when it comes to Reality Labs right now.
Yeah, it seems that way. We'll see if it stays that way. Thanks a lot. Appreciate it, Dan. I know you're going to be busy come 4 p.m. Well, markets are mixed today as investors await that latest round of earnings. For more on the market moves and what's ahead for stocks, let's welcome in Ryan Dietrich, Carson Group Chief Market Strategist. Ryan, is it fair to call you a perennial optimist? Because when I was looking at your note today and you were talking about, the momentum that we are seeing behind stocks, it reminded me that you usually are pretty cheery.
Well, I guess that's probably true. Thanks for having me back. I've been coming on with you guys for a while saying, listen, we're probably going higher, and we're still in that camp. And you've had some great discussions before I joined, but really, I think I want to focus on this for a second here. This month, October, we haven't had a 1% up or down day on a closing basis on the S&P all month. I know there's one more day to go. Only twice in 50 years have we seen that in October. 29 days in a row now. We haven't had a 1% move. What's that mean? That's the longest streak in 3 years. I don't think anyone, including myself, on their bingo card a month ago said this would be like the least volatile October we've ever seen ahead of an election. But here we are. Isn't that interesting?
And Ryan, so the question investors have is how long the good times continue. You say, you know what? Maybe it could last longer than a lot of folks expect.
No, that's right, Josh. We just reached the 3rd year of this bull market, right? The 2nd birthday, which was a couple weeks ago. I took a look, again, going back 50 years. I found 5 times the bull market made it into its 3rd year. So it's kind of like I said like this. Once you're 65 years old, the odds of getting to 85 are really, really high. Bull markets aren't all that different. Looking at those previous 5 times that made it into the 3rd year, like this one. The average was 8 years. The average gain was 288%. This current one is about 2 years old and up about 62, 63%. So who knows? But I'm just saying in history, if you look at history, these bull markets can last a while. And last comment on this, we get into the economy if you want. The economy continues to surprise the upside and earnings are still strong. We simply do not see a recession on the horizon.
So I guess my question would be, what could derail all of this? I mean, we were just, of course, talking about the earnings that we're awaiting from Microsoft and Meta. We got a lot more earnings to go. We got a jobs report. We have more inflation data. We have the Fed. Oh, and we have the election coming. I mean, how are you sort of weighting all of those, and which might be the riskiest for the market?
Yeah, I mean, I think the Fed, right? I think the F word. The Fed could be the riskiest. I mean, we've been in the camp that inflation is last year's problem. We've been saying that all year. And we think the Fed can continue to cut. Keep this real simple. Productivity in our country is very, very high right now, Julie, for 5 quarters in a row. When you have higher productivity, you can have higher wages. The Fed can cut and usually puts a cap on inflation. That's a theme we've been talking about at Carson Group for a long time now, and it's playing out. But just for everyone to put some context around what's going on right now, the S&P is up 5 months in a row. We're like 1 day away from probably being up 6 months in a row. We'll be up 11 out of 12 months in a row. It's been an incredible run, obviously. So I guess the logical thing is, could you be due for a break? Yes, right? I mean, we're not naive to the fact that that's pretty amazing. So maybe we're just due for some break or consolidation. Perfectly normal. But the reality, I think the Fed, a policy mistake, is kind of that one thing, along with the black swan. We've got obviously wars all over, different things that could happen. We're not ignoring those, but I think the Fed is the one that gets us. We think they should continue to keep cutting here.
What about seasonality? Let's get your take on that too, because we are now entering traditionally best 6 months of the year, correct?
No, that's exactly right. We all heard about sell in May, go away. Well, we're up at those 6 months, right? May through right now, through the end of October. Up almost 15%. That's like the best sell in May period we've seen since 2009. And when we take a look at these best 6 months, so the next 6 months, November through April, up like almost 80% of the time, about 7% on average. They are the very best out of all the different 6 month, six month cycles you can look at. This is the best 6 months. But here's what's really interesting. When you're up double digits during the sell in May period, so you're strong and you're usually not supposed to be, like we're seeing now. These next 6 months, Josh, get even better, up almost 13% on average and rarely lower. So, and then we'll put a cherry on top. November, welcome to November. November has been up 11 of the last 12 years. It's the best month on average since 1950, the best month the last 10 years, and the best month in election year. Second best month the last 20 years. Only July's been better. So maybe we get a little more juice out of this. But what last thing on November, it's amazing. I was shocked by this. The last time the month of November was down 1% or more, it's just a modest loss, was 2008. Okay, November truly is a strong month. So maybe there's a little bit left to it here. But again, let's be realistic. Up 11 out of 12 months coming up. Maybe we're due for a little sideways consolidation for a minute here or two.
And then, Ryan, we were just, again, talking about Microsoft and Meta. I'm curious where you're thinking sector-wise, especially when it comes to tech, if that's still a train you want to be riding on.
Yeah, it is. We've been more neutral technology all year. We've been overweight communication services. We thought there was a little more growth there, maybe not quite as pricey. But one of the themes I've come on all year, and a lot of people have as well, this broadening out theme. And I know a lot of people say small caps and mid caps. Listen, small caps, we're up like 13% on the year. No, it's not the 23 we're seeing out of the S&P 500, but mid caps has done well. But I like to look at it like this. There's 11 S&P 500 sectors. All of them are higher on the year. Every single one is up at least double digits. This theme of broadening out has been happening, right? It's been happening this year. And as we look forward into next year and even further out, we think that's going to continue. So we're neutral to technology. We think financials, industrials, those cyclicals, yes, small caps and mid caps, those are areas the next year or two that'll probably continue to do a little bit better than the overall market, in our opinion.
Ryan, good to see you. Thanks a lot.
I look forward to playing some music with you next time. Sorry I couldn't make it.
Yes, please. Yes, come on set with us.
See you soon. Thank you.
And we can have the pre-show party. We're just getting started here on Market Domination. We got a big earnings day on tap, of course. After the closing bell, we'll get you the latest numbers from Meta, Microsoft, Robinhood, and more. Stick around, more Market Domination still to come. Now, time for some of today's top trending tickers. You can scan the QR code below to check out the best and worst and most watched stocks of the session on Yahoo Finance's trending tickers page. First up, a look at Supermicro Computer. Those shares are plummeting, down 31% right now. The company taking a hit after Ernst & Young resigned as the company's auditor, fueling concerns over the company's accounting practices. Now, Supermicro, it did come out with a statement to Yahoo Finance saying, among other things, importantly, the company does not expect that a resolution of the matters raised by EY or those under consideration by the previously announced special committee of the board will result in any restatements of quarterly financial results for the fiscal year ended June 30th, 2024, or other fiscal years. The market doesn't care, right? The market has a lot of questions about the credibility of the company right now, and there's sort of a ripple effect in the market, Josh.
Yeah, so who gains from this pain, Julie? Who do we think?
Two companies.
Who do
It
you
seems
think?
like what the market thinks. Dell, HPE, right?
Team at Evercore does weigh in, to your point exactly, tells clients, listen, you got to take a look at Dell. They say, we think Dell is poised to gain share and remains a logical partner for customers who are looking for better/different supply chain diversity. They reiterated they estimate that Dell's AI server revenues are on track to do $8 billion plus in sales this year.
Yeah, and Wedbush coming out today and saying the risk has increased that Supermicro actually might be delisted because of the delay in its filings. By the way, Supermicro has now announced it's going to give a business update. It's going to do a call. You want to guess when it's doing the call since we're playing guessing games?
Let's do it.
Election day.
Perfect.
Because nobody's paying attention to.
That's exactly when you do it if you're working for those. EY, but we read their statement. I thought EY's statement. We are resigning due to information that has recently come to our attention, which has led us to no longer be able to rely on management's and the audit committee's representation. So tough words, and no surprise the reaction you saw off that. All right, let's turn to Qorvo as well, because that's another name we're watching. Those shares, they are plunging in today's trade as guidance disappoints Wall Street, having Apple as a customer, the weaker than expected outlook from Qorvo highlighting concerns tied to Apple. It was, I did hear Apple, but really it sounds like, and again, they topped estimates, but the guidance was really the issue here. I saw analysts really saying the main factor was the disappointment is this sharp decline they were seeing in Android revenue, Julie. They were talking about how mid-tier Android market is tending to collapse into the low tier, and Qorvo is choosing not to chase the low-end opportunities. I saw Chris Casso over at Wolf saying, he did reiterate his outperform, by the way, but did call the Android commentary specifically, he said, deeply disappointing.
Yeah, and there was a lot of talk about the mix at the company between iPhones, Androids, and how that was shaking out. We got a bunch of downgrades today. BNP Paribas cutting it to neutral, Benchmark cutting it to hold as well, and Raymond James, Srini Pajuri, friend of the show, cutting it to market perform. So a lot of downgrades there for the company and other Apple suppliers, even though, as you say, some analysts were saying the implications were more on the Android side and just sort of going for premium, but we did see other Apple suppliers also fall on the day.
I saw folks were covering also point out this is all coming less than 4 months, they said, after an analyst day at which the company set targets, which they argue already appear unachievable at this point.
Right. Well, turning now to the presidential election, which is just 1 week away. While political pundits are making predictions, it's not just poll numbers that can potentially tell us who will prevail. Economic trends could be giving us some clues about what or who the markets are pricing in. Joining us now for more on the election and the markets, Monica Guerra, head of U.S. policy at Morgan Stanley Wealth Management. Thanks for being here.
Yeah, thanks for having me.
So the polls, I won't call them useless at this point, but everybody talks about it's a coin flip. So you are looking at some other metrics that have in the past correlated with what we see. I'm intrigued by GDP in particular. We just got a GDP reading today of 2.8% in the third quarter. You've been tracking GDP versus sort of favorability. What have you seen? What does it tell you about what could happen?
Yeah, typically during election years, you'll see GDP and candidate favorability go hand in hand, right? They track each other. So if you have a strong year, right, you have strong growth, then you're likely to have, put a check in the favorability for the incumbent who's running. So while Harris isn't the incumbent, right, she is part of the incumbent party. So that could be a check mark in that box. However, we've actually seen some conflicting indications when we're thinking about sentiment. And if you're looking at the Michigan Consumer Sentiment Index, we haven't been this low in the October of an election year since 1978. Okay, and what that essentially signals for us is that that could be in the challenger's favor. So when people do talk about a coin flip, from at least an economics perspective, it very well could be.
So that's no help then.
I thought it was interesting, Monica, you also pointed out in your note how the Republican long basket, though, is outperforming the Democratic long basket. So a couple questions. One, what are in those baskets? And two, what is that indicating to you?
Yeah, so the Republican long basket has been outperforming since March. And what we put in these different baskets were 12 different ETFs, each representing different sectors and industries that might benefit from different policy changes and proposals. So for example, on the Democratic side, you're looking at everything from infrastructure, clean energy, thank you, as well as managed care, right, and others. And then on the GOP side, right, it's more of your cyclicals, your defensives. You're looking at materials as well as crypto, things that might benefit from deregulation, right, Bitcoin beneficiaries, et cetera.
And so the Republican long basket, I mean, there's been a lot of talk about the so-called Trump trade doing well in the market recently as market participants are trying to price that in. Again, I would ask how accurate that, I mean, especially the last, or I shouldn't say the last election, the 2016 election showed us the danger in trying to game it out. But now that that happened, is the market good at predicting, I guess is the bottom line question.
The market, I would say, tends to be good at predicting, but we are in this really interesting environment where voters are incredibly split. So if you look at 20 of the last 24 election cycles since 1928, every time that there's positive market performance in the 3 months prior to election day, that tends to favor the incumbent. The incumbent wins every time in those scenarios. So yes, top level, high level, you're looking at a positive for Democrats, but then when you dig deeper into the beneficiaries, they're telling a different story. We're not in the position of calling the election, right, one way or the other, but I would like to highlight that there is a market anticipation for potential deregulation, right, as well as for companies and sectors that might benefit from tax cuts. One of the things we do want to highlight, though, that was out of consensus in our call and in our view on our baskets is the defense sector. So we called in early February that the Democrats are now the new party of defense. We got some pushback on that out of consensus view, but markets have since been catching up, right, to this call.
What did you mean by that, Monica, the new party of defense?
Yeah, so essentially, if you're looking at Harris's policies, she's not only looking to, extend, right, Biden's current involvement on multiple fronts, but we do believe that there's some signaling that we could get more re-engaged with NATO, et cetera. So essentially, providing fiscal support, continued policy support for those traditional military industrial complex beneficiaries. Now, on the other side, the GOP is taking a more protectionist angle, right? So Trump, yes, while we're likely to get still support for defense spending, the beneficiaries are likely to look different. So when you're looking at that traditional category, it's tracking very closely with Harris's odds right now.
So Monica, as you said, you're not here to call the election, but I'm sure your clients are saying to you, what should I do? We see these are the baskets. Which basket should I buy? What are you telling them? Or are you just sort of giving them the menu and leaving that up to them?
Right now, we're giving them the menu. I think what it is that it gives you your list of choices for post-November 5th, right? Once we have a result, however long that takes. So essentially gives you a place to start for preparing for stock picking post the election once we have a finalized result. The other thing we're talking about is tax policy in 2025 and just reassuring and communicating very strongly that if you are expecting increased taxes, right, on no matter what the outcome, that there are not just tax advantage securities, products, et cetera, but that we can help, right, with those tax mitigation strategies on the market side of the equation.
And then just lastly, on the menu question, is that usually what you do, or is this election unusual because it's so close that you're taking that tack?
It is unusual, right? If you have sort of a sure thing or many indicators that agree, right, and you can start to position going forward, that signaling starts earlier. But right now, we're really advising folks to hold on, not pile in, because if you think about the GOP long basket, since it is this incredibly tight environment, those could potentially be the biggest losers. So we're not, pushing clients either way, and really instead focusing on the known, that is taxes are coming up, right? And that we're going to be really focused on that through the year and providing guidance.
Monica, great to have you here on set. Appreciate it.
Yeah, happy to be here.
Coming up, Reddit shares soaring today on the back of their latest earnings report, and Brian Sozzi sitting down with the social media company's CEO Steve Huffman on the other side. Stick around, more market domination still to come.
Reddit is profitable for the first time ever. The company reporting better than expected third quarter earnings across the board. Profit, revenue, and daily active uniques. Reddit's fourth quarter revenue guidance also blowing past analyst expectations. Joining me now to discuss those results is Steve Huffman, Reddit co-founder and CEO. Steve, I remember when you went public. I mean, it's lifetimes ago. Now you're making money, signing big deals. Thanks for hopping on Yahoo Finance. I'm sure you're really proud of the quarter. I mean, what should the investor takeaway be here?
Sure. Brian, good morning. I'm happy to be here. Look, I think that the story with Reddit is pretty simple. Yes, we're very proud of the quarter we just put up. But really, at the end of the day, our strategy for the last couple of years has been to make Reddit better, faster, safer, easier to use, and that drives growth. And then growth in turn means more reach for advertisers. And I think one of the most important things to understand about Reddit is, look, it's a simple platform, communities and conversations. It's a simple business model. We connect companies, and pretty much every company's customers are on Reddit somewhere. We connect companies with their customers in an environment where they're probably talking about relevant products and decisions. And then the business itself is very simple. We have very high gross margins, 90%. Now we finally achieved this milestone of GAAP profitability, and I think we'll start throwing off more and more cash as we look to the future. So it's a simple company. It's very fun to work on, but if I was an investor, that's what I'd want to understand.
Are investors getting a taste of what a more mainstream Reddit could mean to the top and bottom lines?
Yes. What's unique about Reddit, beyond the consumer product, which itself I think is unique really as the most human place on the internet, but what's unique about the business is that it's very simple. With such high gross margins and our ability to grow the business with modest cost growth. So over the last year, we've grown revenue 4 to 5 times faster than costs. It just means all that revenue, that cash, most of it just flows to the bottom line. And so that's how we've been able to get to profitability so fast. And I think as we continue to scale, you'll see more and more of that.
And we've talked about this in the past, but it sounds like you're getting ready to enter a new wave of growth, or I'm not entirely sure to characterize it, but reboot the search business on Reddit. Like, what are you doing over the next 12 months that will add even more power or heft to the business of search for Reddit?
Sure. So there's kind of two things happening. In the kind of core Reddit product, I think we're hitting a level of kind of an era of mainstream for Reddit. We finally made the product easy enough to use that I think we're hitting this tier of mainstreamness. And so that's been really encouraging to see, because communities are universal. Now, one of our focuses next year will be search, which is a nice opportunity, because it's one of the few opportunities that can both make the experience for new users better, right? Help them find their home on Reddit more efficiently, but it makes the core experience, or the experience for core users, even better, right? Help them navigate Reddit and find answers to their questions. And then down the road, it's also a monetization opportunity. And so it's one of the things that kind of hits everything we care about: new users, core users, and growing the business.
What do you think about these LLMs, or large language models, scraping sites like Reddit? You know, I look at the work we do here at Yahoo Finance. It's very timely, so maybe it's a little different than some of the stuff that you would do at Reddit. But I imagine, they're essentially, they're taking your content. I know you have deals like OpenAI and Google, but they're taking your content for free.
Well, look, we have done a couple of deals there with Google and OpenAI. But at the end of the day, what consumers on the internet want, and also what companies training large foundation models want, is Reddit's content. And Reddit, look, we're open and open for business. Now, the way our content gets out there, we have to be much more considered about than we have in the past. But look, we make our data available for free to researchers and nonprofits. But then commercial use of Reddit's content requires a commercial agreement and requires companies to abide by our public data policy, which really exists to protect user privacy. But look, we're in the market. We're talking to everybody. We've done a couple of deals. We're working on others. But I do think it's better for Reddit to be out there than not. Right? All of our other peers in this space are closed off. And that's really not where Reddit's come from. You know, we believe in the web. We believe in openness. And so as long as we can kind of do these deals or make these arrangements on terms that are, I think, fair to our user base and fair to our business, we'll do our best to do so. And so that's a work in progress right now, but we're making progress.
Steve, whoever wins the White House, Trump or Harris, theoretically, this is going to be the administration that does something about AI regulation, maybe. You know, as a leader, really a key leader in this industry over many, many years, if you were talking to whoever would win the White House, what would you tell them about AI regulation? You know, what would be fair to a Reddit, and what would be fair to civilization?
Sure. So I think the first thing I would ground that conversation is this technology is incredibly important for humanity, and it will create a tremendous amount of opportunity and eventually wealth for everybody. It's a really powerful technology, and we want to make sure as many people have access to it as possible. So I think we have to be very considered in what the regulations are. And then the regulations that we would advocate for are around transparency. So for example, where are these models getting their data? What are the weights between the various data sources, and how are they used? I think that's the sort of thing that is really important for the broader public to know when engaging with any of these models.
All right, we'll leave it there. Reddit co-founder and CEO Steve Huffman, always nice to get some time with you. We'll talk to you soon. Good to see those profits.
Thanks, Brian. Appreciate it.
All right, thanks so much. All right, Julie and Josh, back to you.
Just 6 days to go before the presidential election, and Trump media remains one of the most volatile stocks to be found. The owner of Truth Social plummeting today, cutting into its recent rally. Joining us now with more, Yahoo Finance's Alexandra Canal. Allie, I think it was our Jared Blicker who yesterday tried to count how many times the stock had been halted for volatility. It was tough to keep track.
Quite a few times yesterday halted for volatility, heavy volume trading day as well. And we've seen this massive rise over the past 2 days, rising over 20%. But we're seeing that basically be erased at this point. So some volatile swings to the downside there. Now, there's really no catalyst here. And this is a stock, it operates very much like a meme stock, not based on fundamentals. We know that this is a company that's bleeding money. It has been tied to whether or not Trump is going to win the election in less than 1 week. We did see that steady rise as betting markets started to bet more on Trump than Harris, although the national polling still shows a very tight race there. But I spoke to Steve Stosnick at Interactive Brokers and basically asked him, what the heck is going on with this stock? And he said, look, he trusts markets at the end of the day. And yes, there is a bit of that tied to Trump winning the election, because you could argue that if he does win the election, Truth Social could become a vehicle for him to communicate, his various grievances, some White House messaging. Maybe he has something worked out with Elon Musk down the line. Now, if he loses, the opposite could be true. Where does that leave a company like this? I mean, even the person who's running it right now, Devin Nunes, he's not a social media guy, he's a congressman. So where this stock goes from here after next week, I think is a major question. But like Stosnick told me, you're going to have these very, very volatile swings to the upside, also to the downside, which is what we're seeing today. And he said he expects a lot more volatility over the coming week or so. So we'll have to continue to see. I mean, but right now, the fact is that we wiped $2 billion from the market cap. Stock is still up though, 200% from the September lows. So still a bit of money there.
All right, Allie, thank you. Appreciate it. We move on. Shares of Wingstop sinking today. The company missing third quarter earnings estimates. Look at that. We're down about 21% here, Julie. By the way, I saw biggest intraday decline since March 2020. Restaurant chain reports Q3 adjusted EPS. That does miss. CEO Michael Skipworth trying to sound a confident tone here. Talks about the staying power of the strategies, nearly 21% same-store sales growth, but investors obviously feeling very skittish.
Yeah, I mean, the same-store sales growth is big. I mean, among the biggest that we were watching in the industry right now. However, the profitability, to your point, is the thing that people were perhaps looking for in some of the other metrics was what people were focusing on. One analyst over at TD Cowen said that it modestly trailed consensus and investor expectations, some of these numbers. So there still seems to be some relatively positive sentiment in some quarters around this, but they're looking at a hot company that maybe is going to see some slowing growth compared to what investors had become accustomed to.
Yeah, I was looking at just what bulls were saying. I mean, they were talking about, listen, they were making expectations were elevated, the response is overdone, the growth story's intact, but clearly that's not finding a lot of takers right now.
Yeah. So moving on to our next mover. Yesterday we were talking about brisket. Today we're talking about the black truffle burger.
So yeah.
This is what Shake Shack recently rolled out. Those shares are up 8%. Sales growth strong for its third quarter here. Same store sales growth for this company 4.4%, which was better than estimated. And it seemed like Shake Shack really focused on speed.
Yeah,
and just
for sure.
Anecdotally, as a sometimes Shake Shack customer, sometimes, Shake Shack sort of one of their selling points is that they are making stuff from scratch. They're not quite fast food, but basically fast food. But sometimes you were waiting a long time for your burger. So apparently they have really focused on that and trying to tighten it up.
Yeah, to your point, the company talking about how it's laser focused on improving operations, new worker schedules, food flow in kitchens, helping to reduce customer wait times. Total Shack count reaches 522, expects to add 80 to 85 more locations next year. Apparently, loyalty program, Julie, on the way. The stock, by the way, has been a monster. It is up about 70% now this year. So just remarkable.
And they
remarkable
released
move.
that black truffle burger. So we'll see
go.
how that does for it.
And tune in to Yahoo Finance tomorrow morning, by the way. We're going to be interviewing Shake Shack CEO Rob Lynch. That in the 10 o'clock hour. Our Trane Technologies topping third quarter estimates on the top and bottom lines. The company also raising its full year guidance as it sees bookings nearing an all-time high. However, Trane Technologies did manage a market downturn in China. For more, we have Trane Technologies Chair and CEO Dave Regnery. Dave, it is good to see you. So the stock under some pressure today, Dave, and I know there was softness in China being called out, but why don't you start walking us through the print? What are you seeing in the business and with China specifically?
Yeah, well, thanks for having me on your show, Josh. Look, specifically, we had a very strong quarter. I mean, our organic revenue growth was up 11%. Our EPS growth was up 21%. As you said in the introduction, it was the second highest quarter we ever had as Trane Technologies. So very strong, and we keep seeing a lot of fundamental demand really across all vertical markets. So that's all encouraging. As far as China goes, yeah, China was down. It had a tough quarter. Certainly the markets there are a bit depressed. We've also tightened our credit policy there, so that was the part of the acute decline that we had. But overall, we performed very, very well. This will be the fourth consecutive year that we have EPS growth of 20% or more. So I couldn't be more happy with the results. The team executed well in the third quarter, and as a CEO, I won't get overly concerned with one day in the stock market. I would tell you that our stock is up over 50% year to date. And if you look at it over a long period of time, if you were an investor in Trane Technologies the last 4 years, I think you'd be very happy with the returns. And I would tell you that our best days are really in front of us, because I look at all the mega trends and I look at the solutions that we provide our customers, the paybacks that we have for our solutions. I always tell people that it's green for green. We have great solutions that are great for the planet. They're very sustainable, and they also are very, very accretive to our customers' bottom lines.
Well, Dave, thanks for not coming on and saying, I don't pay any attention to our stock price, which we have heard before. So, acknowledging what's going on here and acknowledging that, yes, the stock has done really, really well this year. I do want to linger on China for just a moment here, because I'm curious what you see now happening in the China business, which, as you say, is a relatively small part of the business as well. But what do you expect in sort of the coming quarters there?
Yeah, I mean, first of all, China is 4% of our total revenue, so it's a very small portion of our business. Look, I think the markets there are down. Okay, it's what you're reading. Okay, we're experiencing it firsthand. We tend to play more in the industrial space in China. Okay, so we're not really tied to the resi side. We're more on the industrial side. The markets are tough. Okay, and they're challenging, and they've contracted, and we saw a pretty steep decline really from June forward. I would tell you, changing the credit policy, also tightening that, certainly was it exacerbated the problem there that we saw. But look, we have a great team in China. It's outperformed for a long period of time, and I'm very, very confident that our team will outperform the markets over the long term.
You know, Dave, one issue that's interesting and where you have real sort of line of sight, and I'm curious to get your take on, how efficient, Dave, are most buildings when it comes to meeting their heating and cooling needs?
Yeah, that's a great question, Josh, because they're not very efficient, right? We've done hundreds of thousands of energy audits, and we know that most buildings are operating about 30% inefficient, meaning that about 30% of the energy after the meter is being wasted. And a lot of times people don't even know it's being wasted. And we have solutions that are available where we'll be connected to that building. We call it, continuous commissioning. So we're always ensuring that those assets, that building, is performing the way it was designed. In today's world, and it will certainly be a greater tomorrow's world, an HVAC asset isn't performing and needs service, not only if it's not heating properly, not only if it's not cooling properly, not only if it's not ventilating, but if it's using too much energy. And that's really the opportunity in front of us. And, a third of our company is our service business. It's over the last 7 years, it's had a compound annual growth rate of high single digits. This quarter was up in the low teens. And this will be certainly a catalyst for us, not only in our service business, but for Trane Technologies well into the future.
Well, and Dave, for people who aren't as familiar with you, you're also a little bit of a shadow play on data centers. I know that's a big and growing part of your business already. We talk a lot on the show about the cooling of the servers themselves, which have their sort of built-in systems. And then you guys are about cooling the building in which the servers live. So talk to me about that business a little bit and how large it is now and how large you expect it to be for you guys.
Yeah, well, we haven't disclosed the size of our business, but we're very strong in that vertical. And you need to think of it as, within a data center, think of it as a system of cooling that has to happen, right? So yes, you need to cool the halls, you need to cool at the rack, and you're hearing a lot about that. But you also need to be able to remove that heat, and that's really done by a chiller. So that's the condensing side of it. We play very heavily in the chiller side of the market, and these are very sophisticated machines. This isn't the same you would find in an office building. And we also play very heavily in the air handling side within the data center halls themselves. At the rack, we have partners that we look at, and one of the things that we do that's sort of unique in this space is we'll look at the entire system and really help our customer work through the energy consumption of the entire system and how to optimize that for our customer.
Dave, it's great to see you. Thanks for joining us.
All right, thanks for having me back. And just a quick story. I was watching the video that we did 2 years ago, because I was on your show about 2 years ago. And I saw in the background that our stock price at that time was $176. So hopefully everyone listened to me back then and they've been a proud owner of Trane Technologies, because you would have done very well. So I'll see you in 2 years, and we'll see if
hopefully
we can double that again.
Hopefully we'll see you before then, Dave. But we'll see, and hopefully for you, the stock price continues to go up. Thanks. Good to see you. Coming up, we're counting down the closing bell and getting you set for another full round of earnings. Stick around, more market domination still to come. The Magnificent Seven stocks are under the microscope as the group has taken up sizable share of the market's gains in recent years. Wall Street now keeping an even closer eye on earnings and growth for the Magnificent Bunch. But with great market influence comes risk. Christian Derry, Capital Fund Management Head of Macro Strategy, is joining us now to discuss. Of course, when it comes to Mag 7, we heard from Tesla, we heard from Alphabet, we're waiting for Meta and Microsoft, but there has been so much talk about how much of the earnings growth is powered by this group. How do you think about tech as a driver relative to the rest of the market?
I think a good way to characterize that is looking at NVIDIA. and its contribution to the overall market. So if we look at NVIDIA year to date, it's 25% of the S&P's year to date return. It's about 25% of the index volatility. And these companies have gotten so large that on earnings events, or we saw Jensen Huang talking at the GS Tech conference how there's insatiable demand for H100s. You're getting these swings of market cap on the order of 200 to 400 billion. So in terms of the dispersion of the index, which is essentially the inverse of correlation, it can account for 70 to 80% of the dispersion in the index. And that's part of the reason that we've seen the correlation on the S&P get quite low. The other interesting vector, I think, to consider is generative AI and the LLMs, it's not software. So the hyperscaling business models were really from software where the marginal costs go to zero. The reality, let's exclude NVIDIA for now, but if we look at the tech incumbents, they have to actually increase their CapEx significantly to build these compute clusters. And the clusters are used to not only train the models, but to do inference, and it's very costly, right? So we saw that Elon Musk just built a cluster he called a Colossus. It's based in Memphis. That's about 100,000 H100s. And the cost of a cluster like that is on the order of the single-digit billions, and the electricity consumption is probably roughly that of a small city, right? So the reality is that the existing incumbents have to build out this technology because they can't risk falling behind their competitors. And I believe Sequoia did a study in 2023. They found that about 50 billion was spent on NVIDIA chips, and collectively the industry generated about $3 billion of revenue. So what that means is we haven't found the killer use case just yet. And the market's going to start to be more discerning in terms of path to profitability, scale. They're going to focus on CapEx and projections for CapEx. Now, obviously, we had Google overnight, and they have a cloud business that did very well, so they can subsidize these new technologies and business models. But it'll be interesting to see, for NVIDIA and the M7, we had Tesla, obviously, it's a different animal, but it'll be interesting to see what the CapEx projections are for these companies, and if they miss, that could lead to a negative reaction in those stocks.
How would you broadly, Christian, characterize valuations for this group at these levels?
Well, okay. So if we focus on something like NVIDIA, right? So it is a quasi-monopoly, has roughly, I think, an 85% margin. It's the world's most valuable company now, so it's displaced Microsoft. I haven't actually checked today, but it's trading on 44 times forward earnings, I believe. So that's pretty rich, relative to averages for equity valuations in the U.S. So it'll be very interesting to see whether some of these new investments actually pay off for these firms. We haven't seen it just yet. Now, to be clear about this technology is extremely disruptive. So even at our firm, we're a systematic manager. We apply a scientific process to markets. We're using a lot of these technologies, and we're finding many novel use cases for this type of technology. So it's clear that it's going to be a big deal, but maybe the market's re-rated these multiples a little too aggressively.
And so what are you as an investor doing with the group? Are you waiting to see what that killer app is going to be?
So we're a systematic manager. So we're, just to give you a sense of...
what do you mean by that exactly?
Yeah, so every day we ingest roughly 5 terabytes of data. A terabyte of that is tick data. We're trading hundreds of markets electronically. We're actually executing over 130,000 trades electronically every single day. So we run a very, very, very diversified business. And we're founded by scientists, essentially, so 100 researchers. There's a heavy physics DNA to the firm. And so everything we do is actually codified. And you can think of it as like hundreds of predictors competing with each other to decide how to trade all these markets globally. And we essentially only invest in very liquid markets globally.
Well, these stocks are liquid markets, as an example. Sorry, I didn't mean to interrupt you, Josh.
Yeah, so we're very diversified, is what I'm trying to say.
Got it.
So that's more the realm of a discretionary trader,
right?
Which is something I used to do in my prior careers.
I'm just curious, Christian, when you talk to your clients about these names, does election risk come up?
Yeah, so we've done a lot of work on that. That's also a fascinating topic. So I saw the previous guest sort of talking through some of it. So we think of it more in terms of scenarios. And the reality is elections are basically small sample properties. So say, you see a lot of charts on social media and things like that showing the evolution of assets, 120 days after the event for an averaging, of all the different election outcomes over time. The reality is there's a lot of variance. If you look at things like, when Obama was elected, it was during the GFC, stocks went straight down. But that's not related to his policies, for example. If you look at Biden, stocks went straight up. Well, that just happened to be after the reopening and COVID, right? So there's a lot of cross currents when you think about these things. We're a quantitative manager, so there's just a lot of noise in terms of trading the election event itself. But we do have to think about the scenarios, obviously. So that's been quite interesting. And we just really look for any imbalances in our portfolio. Because we're a systematic manager, we never actually override our signals. But on rare occasions, we can sort of take down our risk models just to cap the exposures. And ideally, we would incorporate those insights into our process and codify them.
Christian, super interesting conversation. Thanks for coming in for it.
Great.
Appreciate it.
Pleasure to meet you guys. Thank you.
All right, while we are wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell, including the latest earnings from reports from Meta, Microsoft, and a lot more. Stay tuned for Market Domination Overtime.
There's the closing bell on Wall Street. Now it's Market Domination Overtime. We're joined by Jared Blickry and Josh Schaefer to get you up to speed on the action from today's session. Let's see where the major averages ended the day. We start there. We had what was a mixed picture becoming a -1 to close out the session. So dip in the last hour or so of trading leads the Dow down by 89 points, down about a fifth of 1%. The S&P off about a third, and the Nasdaq down about a half of 1%. We did get some economic data this morning, but really earnings really pushing things around here from the likes of Corvo, AMD, kind of pushing the chips lower among other factors. Jared's got a closer look at today's sector action. Hey, Jared.
Hey, that's right. We did have some individual names on the move today. Just quickly want to show you the VIX. That was up to 20, just kind of a big round number there. And then the 10-year T-note, that's been on the decline for a couple of days. Nice to see that as it's taking some pressure off of stocks. But let's get to those heat maps. Communication services, second day in the row, it's leading, or maybe that's only the first. But tech was a big loser today, down 1.5%. Let's take a look inside the Nasdaq 100. You can see some outsized losers here in the chip space, and we'll head over there in a second. But Apple in the upper left, that's down 1.5%. NVIDIA close on its heels. Alphabet was up 2.8%. Nice to see that doing well. Earnings story there. But I did promise the semiconductors, and here we have AMD down 10%. Perhaps in sympathy, we have ASML, Qualcomm, each down more than 4%. Microchip also in that group. And then if we take a look at our leaders here, not a whole lot of green. Solar energy and regional banks in the lead. And to the downside, it was indeed chips. Also cannabis not doing too well. Guys.
Thank you, Jared. Appreciate it. Microsoft's first quarter results hitting the wire here. The company coming out at least with the big numbers, beating estimates here. So let me run through them for you. Revenue we are seeing here at $65.6 billion. That's versus the $64.5 billion that analysts have been anticipating. Earnings per share at $3.30. That's versus the $3.11 that analysts have been anticipating. However, what I'm seeing for intelligent cloud revenue might be a little bit shy of estimates at $24.09 billion. I believe the intelligent cloud estimate that folks were looking for, analysts were looking for, was $26.7 billion. So it looks like maybe that could be short of estimates. But Azure and other cloud services revenue did rise 34%, excluding the effects of currency. I believe that is in line, or even better, actually, than what analysts had been anticipating. So a little bit mixed here, I guess, is what you would call it here on the face of it. Josh Lipton, I have to specify because we got both Joshes on set with me here.
Deck.
What do you think, Lipton?
Interesting with Microsoft. So we don't have guidance as always. You gotta wait for the call and wait for CFO Amy Hood to tell you what she's looking for ahead. So we wait for that right now. Initially here, shares down about 0.7%. It's interesting because Microsoft heading into this print, Julie, it was up about 15% this year. That of course does underperform the market. A lot of attention is on Azure, of course, and there I just see Q and Azure, other cloud services revenue, FX is up 34%, but that'll be a big focus. And a lot of questions too about this company's CapEx trajectory as well, as we talked to a lot of analysts about. They are in spending mode.
Yeah. Josh, you make a good point with Microsoft though, because I think what always stands out to me is we love to look at this release right when it comes out and they don't give guidance on that release. And typically the major move you see in Microsoft shares is going to happen in about an hour or so. Once we get guidance on the call, you usually start to see a clear direction. And you also mentioned the CapEx numbers. I mean, I think that's one of the big things investors are wondering both for Microsoft, also Meta coming out this afternoon. How much are they spending on AI? Are they starting to see that return a little bit? That's also something that Microsoft has been a little bit more specific on once we get to the call as far as how AI is contributing to those Azure numbers. That's been a key metric that investors have been watching the last couple quarters, is quite literally how much can Microsoft attribute that Azure growth specifically to AI? But again, stock's up over 2% right now. I think that's a pretty clear read on just beats on the top and bottom line, guys.
Yeah, it was initially lower, so now seeing a little bit of a boost here. And I'm just trying to look here in the release to see what we get. Of course, a lot of talk about AI from Satya Nadella, talking about an AI-driven transformation, changing work artifacts, and workflow across every role, function, and business process is what he's talking about in the release here. Again, we're looking for that sort of more granular details as to what was going on here. But looking through some of the other business lines, the Microsoft 365 commercial products and cloud services revenue up 13%, consumer and cloud services revenue up 5%, LinkedIn revenue up 10%, something also interesting there. Now that revenue in intelligent cloud that we talk about was up 20% to $24.1 billion. That's the number that I think might have been a little bit shy of estimates, but going to keep digging in there. But to the point of Christian Derry, who we were just speaking to a few moments ago, we are still in this like kind of netherworld when it comes to AI, where everybody's building. Microsoft, yes, has added some functionality related and built it into some of its products. But is that yet driving revenue? Have we, as Christian said, we haven't found like the killer app yet necessarily that is getting everybody to buy the thing.
And I think to that point, Julie, we like to talk about, we'll be curious to see if AI is contributing to these revenues. How's it helping with profits, right? Because that's the overall investor question here. I don't think most Microsoft investors should expect that answer tonight. Microsoft has not said they're going to provide that answer anytime soon, right? That broad question still remains, I think, unanswered for a while now. So it's what sort of hints can you get toward that? But it is a good point that overall, I think we keep coming into these big tech earnings seasons with, is this going to be the quarter where they make more money on AI? And we've only been talking about AI for a year. ChatGPT's barely 2 years old, right? We're still very early days here. And I think you sort of get a sense of that as you read through some of these releases.
Yeah, you'll be looking for more color and commentary with regards to AI. Azure, right, the company's cloud computing business. There'll also be a lot of interest on the call about Copilot, its AI assistant, looking for any kind of color commentary updates as well there.
All right, let us move on to the other company coming out right now, the other big one, Meta. Third quarter earnings there crossing the wire in the past few moments. So let's run through here. A third quarter revenue there at $40.6 billion, about $40.3 billion is what analysts had been anticipating. Ad revenue, there was some nervousness around ad revenue because it wasn't necessarily quite as strong at Google. Ad revenue coming in at $39.9 billion, $39.7 billion is what analysts had been anticipating, and a big beat on earnings per share, $6.03, $5.25 is what analysts have been looking for. And then lastly, the company does come out with a revenue forecast in its release. $45 to $48 billion is what it's anticipating in fourth quarter revenue. 46.1 or so billion is what analysts had been anticipating. And we get Josh Schaefer's favorite, the CapEx forecast here. Full year CapEx, capital expenditure is going to be $38 to $40 billion. They raised the lower end of that. It had been $37 billion. So it looks like that they are spending at minimum a little bit more than they had anticipated spending. I don't know if that's why the shares are down. I should mention, the shares closed at a record today for Meta.
70%.
They're up 70% this year. This has been, besides NVIDIA, the big winner of this year. So maybe that's a little bit of the context.
It felt to me like CapEx was what drove the stock. I believe the stock fell after earnings last quarter, and it felt like it was really on them boosting that CapEx forecast. You brought that up, Julie. Not a major move up there, moving up your low end by $1 billion when we're talking about 38 to 40 billion. Yeah. Not a large percentage move there. But they did also come out and say in 2025 they plan to keep ramping up capital expenditures. I don't think there's been fully clear vision into what exactly that means from a numerical standpoint yet, so maybe there's some questions there. But I think the flip side of that is Meta just keeps beating on EPS, right? This EPS number keeps going up. We're now 2 years removed from Zuck talking about that year of efficiency. Clearly, all of that has come to fruition for the company. So to me, it kind of makes sense if they're able to keep saying that AI is helping areas of the company like Reels, they're building out. Of course, they're going to keep spending on it at some point.
Yeah, so interesting how the company still sees significant capital expenditures growth in 2025. I mean, they are spending on AI and hardware. Obviously, this is a company that has bet big on AI. There are analysts who come on and will say, listen, this is one of those, well, they'll argue you can see the impact. You can see it. They'll emphasize higher engagement. They'll say increase advertiser efficiency, but you'll get a lot more talk on the call. I think the hardware is really interesting too, and obviously that's the Quest AR headsets, that's the Ray-Ban smart glasses that Howley has written about. It does look, that came in a bit light. Q3 Reality Labs revenue, that looks like it clocked in at $270 million. The street was closer to $313.
But it lost less money, a little bit less money than people were expecting. I'm looking at the statement now, and I think I might have gotten to the bottom of this, maybe what people are looking at. So as we said, they raised the lower end of that CapEx forecast. Here's what's interesting. They say, we continue to expect significant capital expenditures growth in 2025. So they're talking about a significant acceleration in infrastructure expense growth next year as we recognize higher growth in depreciation and operating expenses of our expanded infrastructure's fleet. In other words, there's no slowing down. And in fact, there is accelerating potentially in that CapEx next year. So that's something to just keep in mind here. The company also says, is sort of an anodyne statement here, we continue to monitor an active regulatory landscape. Yeah, so that's something also that they say could have an effect.
And I think with Meta, to some extent, context is important, right? This is a company that has dove into other areas. We just brought up Reality Labs and how much they spent there, right? And I think there is perhaps a looming investor question here of, okay, they're going to delve even further in and spend more money. They've gone down that road before and it didn't go, like they got over their skis a little bit. And so I think that's the looming question is, yes, things are going well now, but how far is it going to go? And at what point as an investor, we just mentioned the stock's up 70% this year. At what point have I had enough and I don't want to see how far they're going to go down that well, right? Maybe that's an aspect.
Right, well, it depends on how the core business is doing too. And by the way, they do say in this statement as well, they continue to expect Reality Labs operating losses this year to increase meaningfully. So, they're still committed to that area of the business.
All right, well, let's get more perspective on this. Joshua, and thank you for stopping in. Meta, third quarter earnings per share coming in at $6.03. That beats estimates. Ad revenue also beat for the third quarter, coming in at $39.89 billion. Joining us now is Aaron Kessler, Senior Analyst of Internet at Seaport Research Partners. Aaron, it is great to see you and have you on the show. So let me get your reaction. So Meta prints, stocks bouncing around here, Aaron. We did just take a bit of a leg low. We're down about 2.5%, but give me your reaction to the print, Aaron.
Yeah, so I would say in contrast to maybe Google or Alphabet, I would say expectations were relatively high for Meta given the strength we've seen in the last couple of quarters. Obviously, to your point, stock's been up significantly over the last 12 months here. So the results were basically in line with my expectations, I think slightly above the street, but given how strong the stock has been, not surprised to see it down a little bit. In terms of the guidance, I do think they hit the number at $48 billion in the high end for Q4 that investors were looking for revenues. So I think that's a positive if they can do that $48 billion. But yeah, just given how strong the stock's been, not surprised to see it down a little bit here after hours.
I'm looking at ad impressions here. They talked about ad impressions across all of their apps up 7% year over year. And I know there's been a lot of discussion about how they're using AI in the ad offering. Talk to us a little bit about that and whether you think Meta is doing maybe a better job than some of its competitors in that area.
Yeah, so there's two ways they're kind of leveraging their AI. One is going to be for internal purposes, and I think they've done a good job there. They've been able to automate a lot of the advertising for advertisers, and I think you've seen that in the results. They've talked about that, how it becomes more self-service for a lot of their SMB customers, and that helps drive revenues at the end of the day. Second part is more probably longer term in terms of some of their Gen AI initiatives, and there they may compete with some of the other hyperscalers as well. But there, I think we're still very early. It'll be interesting to see if longer term Meta decides to charge for some of these services. But yeah, I would say on that part, they're still fairly early in terms of offering any type of commercialized Gen AI offering at this point.
Aaron, let's talk CapEx for a second. They see full year CapEx 38 to 40 billion, Aaron. They do see what they call significant capital expenditures growth, it looks like, in 2025. What are you modeling in terms of CapEx, Aaron?
Yeah, so we've been modeling about 38 billion for 2024, so I guess that's kind of the low end. For 2025, we've been modeling about 48 billion in CapEx, so roughly a 25% growth, so fairly significant growth, which is kind of, if you take the second half CapEx for 2024, that's kind of the run rate in 25. I think the interesting thing is from Google, you saw CapEx has been relatively flattish this year, so it'll be interesting if they quantify 25 on the call a little bit more and what the other hyperscalers say when we see AWS tomorrow and what Microsoft says today. But yeah, I think that'll be important in terms of both for the hyperscalers as well as the semiconductor companies.
You just heard us talking a little bit about Reality Labs, too. The company had operating losses at Reality Labs at $4.43 billion, which is a little bit better than the consensus estimate, although revenue there, I believe, was a little bit worse than estimated. We were also talking about how, at a certain point, the street was not terribly happy about Reality Labs and the money that Meta was putting into it. Do we see that kind of displeasure return, or no, as long as the rest of the business is chugging along?
Yeah, I think it's more the latter. As long as they're showing strong top-line growth on the ad side, and as long as they're not seeing significant losses increase on the Reality Labs, we're looking for about 18 billion of losses this year. Last year was about 16 billion. So while they say it's a significant increase, I mean, it's about a 10% increase from what we're looking for. We would like to see, obviously, that loss come down at some point closer to 10 billion, which would still enable them to invest, but we're not expecting that anytime soon.
Let me, Aaron, just to come back to this point, it does look like spending guidance could be weighing on the shares here. I'm just curious, listen, to those who would be skeptical about that, as a bull on the stock, you say what?
Yeah, no, I would say as long as that spending is generating strong top-line growth, which we're continuing to see, we think that's a positive. I think with the stock down a little bit, maybe it's a reflection, maybe not as much revenue upside as investors would have liked to have seen in Q3. But we're still looking for fairly solid revenue growth going into 25. So that's when it becomes an issue, though, is if they're still spending aggressively and growth has slowed. Haven't really seen a significant slowdown in revenues at this point, though.
Aaron, there was a report from The Information that Meta was working on developing an in-house AI-powered search engine. to sort of be less reliant on the dominant companies like Google. Does that make sense, do you think, for Meta? Do you think we learn anything more about that on the call today, for example?
Yeah, I think given their investments in their LLM with Llama and the Gen AI investments, we don't think it's that much of a stretch for them to make a search engine. We don't think it's going to be a direct competitor to Google per se, we don't think it's that much of a stretch given some of the investments they've made over the last couple of years to create a search engine for users that are on Meta already.
Aaron, great to have you on the show. Appreciate that instant analysis, my friend.
Great. Thank you, Josh. Talk to you soon.
Coming up, the earnings fun continues. We've got analyst reaction to the latest results from Coinbase and Robinhood. Stick around, more market domination overtime coming right up.
Robinhood and Coinbase earnings both crossing the wire just minutes ago, and both of the stocks are trading down pretty sharply here. Joining us to help break both of those reports down, Devin Ryan, Citizens JMP Director of Financial Technology Research. Devin, thanks for being here. Let's start with Robinhood here because it is the bigger mover of the two, at least initially. Revenue at Robinhood up 36%, but a little bit shy of estimates here. And I'm looking at an adjusted EBITDA number that also was shy of estimates. What do you think was sort of responsible here maybe for this shortfall? Because coming into the quarter, it looks like expectations were pretty good.
Yeah, hey, Julie. So they actually came in line with us. So we were a little bit below the street. It was below on both Robinhood and Coinbase, but nothing really too complicated. We have July and August monthly metrics, and then September was kind of the one question mark. In September, metrics, our expectation was, transaction activity would be a little bit softer. And so that came through. And so that drove a little bit of the shortfall relative to consensus. And then net interest income also a little bit softer. But again, these are things we pretty much modeled, no major surprise to us. And I think the bigger picture here is their assets, customer assets are up about 50% from the beginning of the year. So when you zoom out, we feel really good about the direction of the company. The September metrics were a little bit soft, and we expected it, and that's what happened.
How much, Devin, do you think the reaction we're seeing here is just, expectations heading to the print were so elevated? I mean, the stock has had a tremendous run.
Yeah, good question, Josh. I mean, that's, I think, the vast majority of it. So I think, to your point, the stocks had a huge run here. The bar was high. They'd have to blow numbers out, to probably, in the very near term, meet the expectations for the stock. That being said, now we have a little bit of a pullback. I would look at this as an opportunity because the reality is the underlying kind of asset gathering that's happening at the company, the business momentum is still incredibly strong. Month to month, trading activity is going to be up a little bit. It's going to be down a little bit. September, as I mentioned, was a little bit soft, which I had modeled. But that doesn't really speak to the momentum in the business, which is gathering deposits, growing retirement assets, really growing all facets of the business, which is why assets are up 50% from the beginning of the year, way more than the broader market.
Hey, Devin, I want to get your take on this new presidential election market offering that Robinhood added. And as you say, really the building of the business. Robinhood is an interesting one because on the one hand, it still has that sort of buzzy legacy. It does kind of like, I don't want to call it gimmicky, but it does attention-grabbing things like introducing a presidential election market. But as you say, the core business is growing people's sort of retirement money. So how do you think about those sort of more attention-grabbing offerings with relation to that core business?
Yeah, I think they want to have everything, right? So they started the firm, and a lot of their initial customers were first-time investors, and those are still a lot of their customers today. But as the business has evolved, they've then gone after active traders, and now they're making a huge push, especially with their unveiled kind of new offerings over the past couple of weeks, where that's a big target market for them. And so you think about some of these other offerings like the election trading. I think that resonates with a small sliver of potential investors, but if it resonates with some, they want to provide access to it. And so that's when I think about what Robinhood is building, they're providing access to all things in financial markets, on the trading side, and then over time evolving the platform to be able to really help customers with a lot more of their financial service needs, whether it's credit cards or cash management, or over time, I expect there's going to be many other features that they add here that are complementary to that.
Devin, I want to switch gears, talk about another name I know you cover, Coinbase. They reported stocks down a quick 6% here in the after hours. What do you make of those results?
Yeah, I think a lot of the same, Josh. Just bar was high heading into results. We can track the volumes, so the actual trading volumes were down in the quarter, but we knew that. What we didn't know was what the mix would be between institutional and retail. I was a little bit below the market or below the street for our expectations, so not a big surprise to us. But revenues there also missed a bit here. And again, that's so backward looking for them. I mean, really what matters with Coinbase is the evolution of the firm, getting on the other side of the election, what's the outcome there. You're already seeing activity in October way up over September. So, I feel very comfortable with the direction of their business. And then, again, I think these are stocks that if you're going to look at them, of course, they're going to trade a little bit around earnings. But these are companies that, in my opinion, are kind of transformational in their categories. And so Robinhood, focus on the big picture. What are the client assets doing, the deposits, all the the new features, and then on Coinbase, what's happening both with trading and the exchange, but then also half of their business is coming from subscription and these other revenue drivers that are not just about trading volumes on their exchange. And I think that's a much bigger part of the story over the next few years.
So, Devin, all of that being said, and your point is taken on you seeing the sort of bigger picture here, Coinbase did turn profitable, but boy, it was a lot less profitable than people were expecting it to be. So on a per share basis, that translates to 28 cents per share versus the 43 cents in earnings per share that the street at least were looking for. I don't know off the top of my head where you were, but is it spending part of the issue here? How are you thinking about the profitability here?
Yeah, so spending matters, and I think that's an area that investors, I think, have given them a little bit of a hard time on over the last couple of years. So if you guys recall, early in 2023, they made some pretty substantial cuts to their spending plans to right-size the business and put themselves in a better position to play offense when revenues recover. And of course, revenues have been recovering. But at the same time, they're in a nascent market that's growing very rapidly, and they need to maintain their market share advantage over a lot of peers. So I think it's a balance. Again, the big picture and what's going to drive the stock, it's going to be, I understand there's a little bit of a knee-jerk reaction to a headline. What's going to drive the stock is their ability to grow over the next couple of years, and are they differentiating the platform, and also are they adding to all these other parts of the business model that are outside of just trading? And so yes, Julie, spending matters, profitability today matters, but I think there's also that balance that I actually think they're threading that needle fine. And as I mentioned, this quarter, the results are pretty much as we were expecting. So no major surprise to me. I appreciate the knee-jerk reaction, but I would look at this as an opportunity really for both names.
Devin, always good to see you and have you on the show. Thanks for joining us.
Thanks so much.
Microsoft delivering better than expected results for the first quarter. The company also reporting cloud revenue slightly above the street's expectations. Microsoft also saying AI contributed 12 points to Azure revenue growth in the quarter. RBC Capital Markets software equity analyst Rishi Jaluria joining us now for a closer look. Rishi, it is great to see you. So Microsoft reports the stock here in the after hours. Rishi, it's up about 1%. Of course, we don't have guidance yet. We'll look for that on the call. But give me the Rishi Jaluria instant analysis here.
Yeah, and thanks, Josh. Always a pleasure to be on your show. So thanks so much for having me. Look, I think the couple things strike out to me. Number one is it feels like sentiment has gone a little bit more muted on Microsoft. So expectations weren't too crazy heading into the print. We saw Azure actually beat at a time where people were worried about Azure missing. We actually saw AI kind of accelerate a little bit as well. But more importantly, Azure X AI, the core Azure, is actually accelerating on its own. So that's, I think, all very encouraging to see. And, look, when we talk about AI as a long-term growth driver, tell me any other enterprise software company that's getting $6.1 billion in ARR from AI today. By the way, that too with a conservative definition of what's in that AI bucket. I think it does not include any training of OpenAI models at all, mostly inferencing and fine-tuning. I think they're in a really enviable position. Yes, there's a lot of CapEx. Yes, I think the jury's still out on Office Copilot, and we're waiting to see, what Satya and Amy have to say in terms of is there that back half acceleration in Azure still coming. But I think all things considered, pretty pleased with what we're seeing here.
I'm also curious if you're happy with the amount of sort of transparency, clarity that we're getting on the contribution from AI. I mean, I'm just seeing this headline here that AI contributed 12 points to Azure revenue growth in the first quarter, which seems pretty specific and maybe more than we're getting from some of its competitors. What do you think?
I think that's exactly right. Look, the fact is they're actually willing to quantify it. And, as I kind of alluded to, they use a conservative definition. It is primarily OpenAI as a customer in terms of people like us being ChatGPT customers, in terms of other companies using the OpenAI APIs to develop, and then GitHub Copilot. Those are the biggest things. So the fact that they're actually willing to call it out, and I think, again, I need to emphasize, they're not including all the training of GPT-5, GPT-01, all of that, whereas I do believe others may be doing that. I also cover Oracle. I would not be surprised if OCI does include training of Cohere models. And so I think there's a conservative number, and they're providing a greater level of transparency than others. And I think that's something that I hope others can follow suit, because that really makes the markets work better is when we just have more information.
Rishi, I know you don't cover Amazon or Alphabet, but I am curious to get your take on, just how you think as a financial analyst about Microsoft in the great cloud wars right now, and looking ahead, what you think their real competitive advantages are going to be.
Yeah, I think there's a lot of advantages that Microsoft has, even before the OpenAI deal and GenAI taking the world by storm over the past 2 years. I still think they were in the best position because they had the most enterprise-grade technology, and maybe most importantly, they have the full stack from IaaS to PaaS to SaaS. You'll notice Amazon, for example, which my colleague covers, doesn't really have as much at the application layer relative to Microsoft. So I think that Microsoft is in probably the strongest position of any of the hyperscale cloud vendors out there. And now you layer in the OpenAI partnership, the fact that Microsoft is infusing AI throughout the entire stack, the fact that companies, there's this Azure halo effect that's going on where companies are actually giving more share to Microsoft because they're so impressed with the AI roadmap and all the innovations that's happening at Microsoft. I think it honestly puts them in the strongest position out of any of the hyperscalers.
You know, a lot of the street agree with you, Rishi, in terms of your analyst peers, and yet the stock this year, kind of meh, right? It's up 15% or so. Going into tomorrow's session, which we'll see the reaction to these numbers. What do you think is going on there? Why is there that sort of gap?
Yeah, it's classic market philosophy of people get ahead of themselves, get overly excited, and then any small blip is enough to get people disappointed. One of the biggest pieces of feedback I hear from people is, look, the other hyperscalers are also doing AI, and I would maybe contest not nearly in the same way. But then I would also say, there's a lot of disappointment over Office Copilot. And look, in my mind, this is the standard Microsoft playbook. They come to market with a product that may not be fully there, but they'll make it there, right? They did this with Microsoft Power BI and were able to eat the lunch of all their competitors. They did this with Microsoft Teams, and look what they were able to do to Slack. Even for the viewers who are maybe old enough to remember, the first version of Microsoft Office was pretty terrible, right? And paled in comparison to other offerings like Lotus 1-2-3 out there. And now Office is the kind of de facto standard quasi-monopoly in the productivity space. So I think they'll figure it out. It might take a year before Office Copilot really becomes incremental to revenue. But I think that's maybe why the stock hasn't been performing as well as a mega cap company that's innovating at this level that is actually playing from a leadership position when it comes to AI should be.
On the call, Rishi, we're going to get that forecast, the guidance. Curious, what else are you listening for? What do you want to hear from Satya Nadella and Amy Hood?
I think beyond the numbers, right, and the guidance and the reiteration of acceleration for Azure in the back half of the fiscal year, it is really going to be any kind of color we can get around Office Copilot. Because I still think, even though I'm saying you have to exercise patience, any proof points in terms of enterprise adoption, in terms of new product development, in terms of, more, things to come in terms of innovation, I think those are things that I'm paying attention to. And then other ways that maybe there is potential for Microsoft to be share gainers in parts of the market that they haven't been super strong in. I would say, for example, front office CRM, they have Dynamics 365. It's been kind of I would say a relatively disappointing business, even though it's technically been a share gainer. But with the advent of bringing Gen AI into this and having Copilot for sales, Copilot for service, Copilot for marketing, can they actually turn back into a real share gainer in that CRM space? So looking for all these things of where can AI turn into a growth driver for parts of the business that maybe investors aren't fully paying attention to today.
Rishi, thank you so much. It's great to see you as always. Appreciate it.
Thank you so much.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break here, it's asking for a trend. We're going to continue to break down the latest round of earnings reports and get you set up for everything you need to know for Thursday. Stay tuned. Welcome back to Asking for a Trend. The earnings fun continues as DoorDash, the latest to report, those shares lower despite the company posting a profit for the first time since going public in late 2020, beating expectations on the top and bottom lines. So, about 0.8%. We should mention, of course, this is another one that had a big run this year into the print. But they did beat on metrics here. I mean, 107 million in operating income. That is a beat, it looks like. Q3 total orders, adjusted earnings, look like those are beats as well. Maybe I'm looking to the fourth quarter outlook for adjusted EBITDA. That is roughly in line. So maybe that's a bit disappointing, at least initially or in the after hours. We're basically flat.
Yeah, I think that the shares closed at or near a record in today's session
very
after
elevated.
that monster move upward. Total orders up 18% to 643 million. Marketplace gross order volume up 19% to $20 billion. That was a little bit ahead of what analysts had been anticipated. And the company said they saw growth in consumers, growth in average consumer engagement as well. Those were the things driving the orders. DoorDash, I didn't realize this, according to Bloomberg, has 2/3 of the meal delivery market share in the United States. So that's a lot. It's sort of the dominant player here as we see the increases that it saw in orders. And that adjusted EBITDA number for the fourth quarter, it's looking at $525 million to $575 million in that adjusted EBITDA figure. And marketplace gross order volume, again, one of those things that they look at for DoorDash, 20.6 to 21 billion is what it's predicting there.
On the call, you're going to see a lot of interest in their two big initiatives. That's new verticals and international markets. You also have a membership program. All of that, I'm sure, will be chewed over on the call.
I'm sure it will. All right, we've also got the latest reports from Starbucks and Roku just coming out. Yahoo Finance's Brooke DePalma and Alexandra Canal joining us now for more. Brooke, let's start with you. We did recently get a pre-announcement, but there was still a lot of interest in this Starbucks report.
Good afternoon, Julie. That's right. As Wall Street anticipated, these official Q4 results were in line with those preliminary results announced last Tuesday after market close. It really shocked the street just in terms of the timing, not necessarily the results. A quick refresher here in case you missed those. Revenue for the quarter came in down 3% to $9.1 billion. Adjusted earnings per share fell 25% to 80 cents, and same-store sales dropped 7%. That was more than the nearly 4% that Wall Street had expected. Now, two numbers that investors are really focusing in on is that U.S. foot traffic that did fall 10% in Q4. Now, that's worse than what we saw during the financial crisis for Starbucks. And international same-store sales dragged lower once again by their second largest market, China. In China, we saw same-store sales fall 14%. But investors certainly looking forward to that 5 p.m. Eastern call. Despite much buzz, this will be the new CEO, Brian Niccol, former Chipotle CEO, now Starbucks CEO's first call with investors. And we really expect to hear more about how he plans to re-strategize and get Starbucks back to Starbucks, essentially back to the basics. We know that he plans to simplify the menu, fix pricing after Starbucks increased prices in recent years to offset inflation, and really improve the speed of service. Now, in addition to that, Niccol really plans to get customers back in the door. We know that their reward members have not grown quarter over quarter, and they are still lower than the amount that we saw in Q1. Julie?
I'll take it from here. Thank you, Brooke. Alexandra, shares of Roku down about 4.5% there. What's happening?
Yeah, they were down as much as 8% on the heels of this report. And digging through things here, it seems like the stock is down due to guidance for the current quarter. The company estimating that total gross profit in Q4 will hit $465 million, with adjusted EBITDA expected to come in at $30 million. Now, both of those are below estimates. Analysts polled by Bloomberg had anticipated gross profit to hit $477 million, with adjusted EBITDA previously expected to come in at $36.2 million. Now, outside of those metrics, Q4 revenue guide also seemed to be of a bit of a disappointment, $1.14 billion. It did come in slightly ahead of expectations, which were set at $1.11 billion, but looks like shareholders just wanted more here. Now, guidance has been an issue for Roku in previous quarters. Heading into this print, we have seen a bit of a rally in shares over the past few months, but we're seeing these results erase some of those gains. But for the actual quarter results, I mean, they look pretty good. Q3 revenue came in above expectations. Adjusted loss of just 6 cents a share compared to 33 33-cent loss that was expected. So a much narrower loss compared to those estimates. Platform revenue, which we know has been a consistently more important metric for this company. That includes ad sales, revenue from distribution deals, and the Roku channel. That beat estimates of $860 million to hit $908.2 million. Device revenue, however, we did see a slight miss, $154 million compared to the expected $154.6 million. And we have seen more competition on the device side of the business, so possibly that pressuring sales as well. And then final thing here, they announced a change to their key performance metrics. They said beginning in the first quarter of 2025, they are no longer going to be reporting updates on streaming households and by extension, average revenue per user. They're just going to focus on streaming hours, platform revenue, adjusted EBITDA, and free cash flow.
Interesting.
So a bit of a change there as we kick off the year. But this company has been up about 35% since the last earnings report. We have seen a mixed commentary on the street about where things could go heading into year end. But it seems like for now we're seeing losses lessen, but still down about 5%.
Thanks, Allie.
Yeah,
and thanks, Brooke, as well. All right, let's get to one more. Shares of Etsy are up about 12% following its third quarter earnings report. The company reporting mixed results. Profit did miss expectations. Revenue came in above estimates, and third quarter gross margin coming in just shy of the street's estimate and the company's guidance for that metric for the fourth quarter. So they say it's going to decline by low to mid single-digit percentage. Etsy also announcing a new $1 billion share buyback program. Now, these shares, unlike most of the ones that we've been talking about, are down about 40% going into
hit a
this report.
52-week low yesterday. Actually.
Yeah, and they sort of acknowledge that it's been a challenging year. Josh Silverman, Etsy CEO, talked about that that there's been incremental pressure on Etsy marketplace year-over-year gross merchandise sales, but he talked about investing with discipline and focus at the company after what has been a challenging period. The consolidated gross merchandise sales he's referring to, $2.9 billion. That's down 4.1% on a year-over-year basis. Gross merchandise sales, for folks who don't know, is basically the value of all the stuff that is sold on Etsy. So that went down a little bit.
Yeah, it's interesting his comments here. He talks about, listen, it's been a challenging period for discretionary goods, but talks about we're investing with discipline, focus to make Etsy even more Etsy, which we believe will lift our boat when the tide comes back in again.
Yeah, revenue up 4.1% at the company. So that's the number that beat estimates.
All right, time now for what to watch. Thursday, October 31st, it is Halloween, of course, and on the spookiest day of the year, we had a couple more earnings reports from the Magnificent Seven, including Apple. Apple announcing results for the fourth quarter after the close, the company jockeying with NVIDIA over the last week for the top market cap in the U.S. Analysts expecting China iPhone sales to be a focal point of the earnings call as reception in the U.S. for the iPhone 16 has been sluggish.
And some other earnings we'll also be watching tomorrow include MasterCard, Uber, Comcast, and Intel. Although, by the way, I think the spookiest day of the year is next Tuesday. Taking a look at the economy, monthly PCE data for September. That's personal consumption expenditures coming out in the morning. That's a measure of inflation, of course. Economists forecast both core and total PCE will speed up compared to August, with core PCE at 0.3%, total PCE at 0.2%.
And finally, we're going to be getting weekly mortgage rates in the afternoon. Rates have risen 4 consecutive weeks. 30-year fixed currently at 6.54% as home buyers continue to navigate a sluggish housing market. Well, coming up, it was a big day on Wall Street. We're taking a look at the top trading day takeaways. Stick around, more Asking for a Trend right on the other side. Oh, this is me. New GDP data giving us more insight into the economy, and big tech earnings continue. Yahoo Finance's Joshua Schaefer joins us now with more on the trading day takeaways. Josh.
Yeah, Josh, so I'm going to keep it broad here because, as we mentioned, there is a lot going on right now in markets. So I want to start with the economy. So we had GDP data out this morning. We also had ADP payrolls out this morning. But let's start with that Q3 GDP number coming in at 2.8%. This was slightly below Wall Street's estimates for 2.9%. So you could say a little bit below expectations there. Certainly didn't surprise to the upside by any means. But as you can see here, about in line with the 3% we saw last quarter. And I think the read from economists on this was U.S. economy remains very much on solid footing headed into the fourth quarter. This, of course, coming as the Fed is cutting rates. We've talked a lot about that being perhaps a bullish backdrop for stocks. To have this level of growth when the Fed is cutting, normally you would maybe even have a negative GDP number when the Fed starts cutting, right? Because they're trying to help an economy. So for this to be the backdrop, pretty solid. Then you add in the data we got on the labor market this morning. So ADP private payrolls, 233,000 jobs added in October. That was the largest you've seen in about a year, going back to July 2023. And really what ADP chief economist Neil Richardson told us on the call this morning, call of reporters, was you're starting to see a little bit of a pickup again. After 5 straight months down, you're seeing a solid, broad pickup where she feels pretty solid overall about the labor market picture.
Yeah, it'll be interesting that big jobs report too, because it's going to be noisy.
Yes.
I mean, hurricanes, strikes, those economists try to find the underlying trend in all that.
So an interesting point on this number, ADP accounts for hurricanes, strikes, things like that a little bit different than the Bureau of Labor Statistics, which releases Friday's jobs report. And so actually it wasn't that big of a factor in ADP's report. So basically you can say 233 was almost without strikes or hurricanes. So if there were to have been those impacts that people are expecting for Friday's report, number would probably be lower. But the thing, Josh, and I wrote about this in our morning brief newsletter on Monday, we're all expecting that. So at some point, if everyone's expecting the number to be bad, then at what point is bad, right? We're looking for one of the worst non-farm payroll reports of the year as far as job additions go. So that's a little bit expected. And number two, there's been a lot of other data that's shown a little bit of weakening labor market data, a little bit of weakening in the overall labor market picture that leads to a Fed cut. So I'm not sure how much Friday can really move the needle, but of course, we're going to find out.
We'll see. All right, big tech.
Big tech. So this is just a basic one, Josh. We've been talking about big tech earnings for the last 2 days after the bell, right? And what's caught my eye is, so when we talk about S&P 500 earnings for this quarter, 18.1% is the growth you're expected to see from this group here.
Yeah.
0.01%, or sorry, 0.1% is what you're expected to see from the rest of the S&P 500. So most of the index's earnings growth is expected to come from these companies. Beat on earnings. Beat on earnings. Beat on earnings. So right now, the trend has been solid for the Mag 7 to drive this earnings growth for the S&P 500. We got 2 checks again tomorrow. We're going to see with Apple and Amazon. But thus far, big tech has sort of done its job for this stock market rally of, okay, earnings are continuing to grow. That's why stock prices have been going up.
Apple's really interesting to me too, because the sentiment has been it just seemed sort of bearish in the last few weeks. You had some noise, headlines around production cuts, and so it'll be interesting what that print is tomorrow. iPhone China, Apple Intelligence, all in focus.
The thing that sticks out to me with that though too, Josh, when you take a look at Apple stock, I mean, isn't it still trading near a record high? I agree with you. Commentary has been bearish.
Yeah.
Barely underperforming the market though, and I think about 4 percentage points off an all-time high. So it's been interesting to see the stock still perform relatively well.
Maybe some
curious how it trades out of earnings.
Quality you've written about. I know. Yeah. All right, we'll find out. Thank you, Joshua. Coming up, I'm checking in on a few other tickers that are moving after hours. Stick around. Much more asking for a trend still to come. Let's take a look at what is trending now after hours. Shares of eBay, they are sliding after reporting third quarter results, and it's the guidance that seems to be spooking investors. Net revenue guidance for the fourth quarter and full year, both coming in below Wall Street's estimates. And for the third quarter, earnings and revenue beating analyst expectations. Now let's take a look at Carvana as well. That stock surging after the company reported a Q3 beat on both the top and bottom lines. Revenue coming in at $3.66 billion. That's up 32% year over year. The company also saying it sees its full year adjusted EBITDA coming in significantly above the high end of 1 to 1.2 billion. And turning now to Twilio, those shares rising as it delivers upbeat guidance. Adjusted earnings per share fourth quarter outlook did top Wall Street expectations. Twilio also increasing its full year 2024 organic revenue growth guidance. As for its third quarter performance, the company beating estimates on the top and bottom lines. Well, that's a wrap on today's Ask for a Trend. Have a great night.